Good morning and welcome to Indian Open right here on BloombergQuint Live. I'm Neeraj Shah, with me is Devina Khanna. And, Devina, good morning. It doesn't seem to be a very great day of trade from a bull's perspective, a bit of a difference from what was the case yesterday. Mind you, the SGX Nifty has actually slipped a bit lower from where we were about half an hour or an hour ago. And the US markets has issues of its own, Devina. We seeing the cases still on the rise there, and while there is a whole talk of reopening, etc., the data out there isn't quite the best. I mean, the demand slump in crude has led to crude lower as well. So the data on the US markets too isn't the most positive.
Yeah, you've got IEA. Good morning, Neeraj. IEA is suggesting that demand could be at record lows, which is why you saw crude plunge the way it did. So that may be a silver lining for our economy, but definitely not doing anything for the US markets. On the macro side as well, the rest of the data points that came out from the US were also a little bit disappointing. You had the retail sales plunged the most in some time. 8.7% lower is where the retail sales plunged. Manufacturing output was one of the lowest since 1946. So all of those pointing towards some pain points and pressure points within the economy, which again could be reflected in the stock market performance as well. Yesterday's session saw all the three major indices close lower. Right now, the Dow futures, the S&P 500 futures are also suggesting that this pain could linger on for a little while more. But it's just to put into perspective that, now, and even it's probably not so much just about the US equity markets, but even in the Indian markets, days on a trot where you've been seeing price fluctuations more than 3, 4, 5% seems to be becoming a norm. Now, if you take a look at S&P 500 itself, while the CBOE Wix has come off from highs of about 85 to 40 now, and the number of days from March 1st that S&P 500 has fluctuated more than 3% is 23 days on a trot, and that seems to be becoming a new normal, the kind of big price swings, which again may actually not be too great for traders, Neeraj.
Yeah, but the guy who put this into perspective, Devina, is Ray Dalio, and an interview of his will be coming up on our feed sometime during the day. Story around what he said is there on our website as well. But in the nutshell, the one key point that I took out of that interaction and that story is that he's saying that the economic and the social impact of the coronavirus will be worse than the financial crisis and more analogous to the Great Depression. And that tells your story, doesn't it? So, well, the long and short of it is we'll start off lower today. We may head lower today because banks, IT, and to an extent FMCG too, which had a big rally in trade yesterday, might all be giving up some of those gains or actually sliding further. I would say that we may actually have a day which is worse off than what the start is suggesting. But the key to this kind of a day is what IT will do because of Wipro's results and the commentary that they've given. Would it have a big bearing on Nifty IT? Let's put that into perspective. First, get in Agam Vakil to talk about what exactly happened in Wipro. And then we'll, of course, talk about what to expect from TCS too after what Wipro has done. But Agam, good morning. Seems to suggest it's not going to be a good morning for Wipro. The ADR kind of was a big giveaway.
Good morning, Neeraj and Devina. Yes, absolutely correct, because it's not as much about the quarterly performance for Wipro as much as it's about the outlook that the management has provided. But I'm going to take you through very quickly the earnings right now. As far as the IT services is concerned, it's seen a decline of around 1%. That is in line with expectations, but it is below the BQ poll just slightly, and it's also below the company's guided range. As far as your IT services operating margins go, they have seen an 80 basis contraction at around 17.6%. There is weakness in BFSI, consumer business unit, and energy. These are the three of the biggest verticals for Wipro. And the company, of course, perhaps the most important thing that stands out is that it has temporarily suspended the provision of a quarterly guidance. The company is suggesting that these times are very uncertain with respect to the business environment. In fact, they have said that they're expecting the impact of the coronavirus to peak in the ongoing quarter, which is why it will be very hard for them to give any sort of guidance. There has been, as far as clients are concerned, there's been cut in discretionary spends. There is already low demand. There's also lower pricing on account of discounts, and clients are also asking for elongated payment terms. So on the whole, not the best of the outlooks given by Wipro.
Okay. What about TCS? That's the other big one that we're going to be watching out for. While the start of the earnings season for Wipro has been on a softer footing, is the same fate expected for TCS?
It certainly sets the tone, Devina, and I'm sure that we will start seeing some concerns when it comes to TCS as well, even though TCS is nearly 4 times in terms of the size as compared to Wipro. But what we are expecting is a revenues decline of around 0.5% in dollar terms at around $5,560 million. EBITDA margins are expected to remain largely stable at around 25%. Net profits likely to see a growth of around 1.2% sequentially. There has been a lockdown in India and developed markets, and that's likely to weigh on TCS earnings. There has been lower billings that a lot of analysts are already anticipating and working around. And there is, of course, a large exposure to BFSI in as far as US and Europe is concerned. And the economies out there are also something that there is a little bit of a question mark for now. So what we are looking out for is the outlook going forward, and of course the near-term challenges that the company has to face with respect to the ongoing environment.
Okay. Agam, thanks so much for putting that into perspective. Let's get in Nitin Padmanabhan from Investec to talk about his thoughts. Nitin, good having you. Thanks so much for taking the time out and speaking to us. Good morning. What do you make of some of the points or some of the comments that Wipro gave? They sounded very disconcerting. How did you read into them?
Yeah, hi. Good morning, Neeraj, and thanks for having me.
Pleasure.
So I think this is how typically you'd see things evolve during a crisis. So I think for the first thing is that when you have such sharp drops of this nature, you typically have clients on the first phase just trying to keep lights on and get things moving. In the second phase, they need to conserve cash because they themselves are, struggling for liquidity, seeing sharp drops in their own businesses, and the entire view of business changes from return on investment to conserving cash and what your cash burn is. So during the second phase, you basically, which is trying to conserve cash, you basically have people looking to cut discretionary spends to save cash, try and cut pricing, and basically push out payment terms to a later date. All this is just to conserve cash. And then I think phase 3 is different. Phase 3 is when you're out of this sort of scenario and as the dust settles, and then you look at your business and there has been an impact, and then you sort of re-strategize your whole IT spend. You may completely cut down the pace of your spend depending on how bad you're hit, or you may calibrate it depending on the bottlenecks that you face during the crisis and so on and so forth. So Wipro's commentary is really no different from what would typically happen in terms of client behavior during such a crisis. And it basically tells you that initially you will have this sort of uncertainty. Now, I think one thing to bear in mind is there's a lot of comparison with the GFC, which is the global financial crisis in 2008. But there is a difference between that, because if you go through the numbers of IT services companies during that period, you notice that, and it's very obvious, right? You had, at that point, it was driven by financials, and then there were a few sectors which were impacted. So if you look at the numbers of IT services companies then, you had drops in BFSI, you had drops in manufacturing and telecom. But this time around, it's across the board. It's across every possible vertical you can think of. So the uncertainty is even higher. It is worse than what you would see in GFC. So that explains where Wipro is coming from in terms of their commentary and the relative uncertainty.
Nitin, good morning. You can read much by what they have to say about what lies ahead. Obviously, the deal pipeline is going to start to get squeezed out a bit. Could you extrapolate some of their commentary and also the fact that You've seen what Cognizant has done. You've seen what Accenture have done. And therefore now the expectations from the big four here in India too, TCS comes out today, should be limited. Don't expect too much.
Yeah, hi Devina. Yeah, I think that's precisely the case. So a few things to keep in mind. So when Accenture gave their guidance, we were a little early into the cycle, right? Things were evolving. And you would speak to companies and realize that things were changing almost every 3 days. Their own view of the impact kept changing. So because the way this crisis is evolving has been pretty fast. And you have every major market being impacted. So yes, definitely you would see that every company will see these impacts, and it's unlikely that anyone will remain completely unscathed. But from an investor point of view, I think what's very clear is there will be sharp drops. It's time to be greedy. Look at stocks where you get it at very fair entry points, very great entry points. You can be as greedy as you want with those entry points because the way results will come out. And I think Q1 will be pretty bad across the board for everyone, considering the uncertainty, and that fear will actually lead to better valuation multiples for you to enter and then sort of make decent returns. So that's how I'd think about it, Devina.
Okay, let's talk about one or two important things that you will be watching out from the TCS management's commentary.
Yeah, sure. So I think it's going to be the same thing. So one is, in terms of their own responses to what's coming out. So for instance, if you look at the last crisis, I think it was the first one of that size and scale. And Indian vendors basically sat back and waited for clients to respond. And you had quite a few of them come out and ask for pricing cuts. And those pricing cuts, once that happened, it never came back. Those prices never came back over so many years. So it's very clear that, allowing clients to really cut prices, then you basically will never recover those. So basically trying to understand how TCS is sort of responding to that. We understand that there are companies which are proactively reaching out to their clients, telling them these are the areas where you cut your spends, and thereby empathize with them and help them cut their spend so that they don't resort to pricing cuts. So you will see vendors sort of respond to these. So I think that's one thing we'll look for, how is TCS responding. And the second thing is their own, considering the size and scale, their own assessment of how things are going to pan out, when do they expect, what is the kind of impact they sort of expect across different verticals, who is impacted more, and so on and so forth. More specifically on the banking side, because banks are a large proportion of revenue. So these are the key basic areas. I don't think on margins anyone will be able to give much of a clue at this point, but I think there again, how well are you poised to sort of defend your margins?
Then just to ask one last question, whether or not looking at Wipro's numbers, you feel that there is more downside to the stock and there are possibility of further downgrades coming in?
Yeah. For Wipro, the thing is, you look at the stock isn't that expensive either. So it's 1 lakh crores of market cap, you've got 25,000 crores of cash, and you have earnings on an average of 10,000 crores. So that gives you an EV by EBITDA of around 7 times. And a 10% drop makes it 6.5 times. So a stock isn't too expensive. Whether there'll be earnings cuts, possible, but again, there's also a likely recovery that will happen next year. So if you look at, we, in our own estimates, when we did sort of think about how this will evolve and we assumed a certain framework to cut numbers, we did cut numbers very sharply across the board, anywhere between 13-14% to 30% on earnings, assuming sharp drops and a 6% revenue decline for the year. So our estimates already build that in. We think there is a catch-up by consensus that will happen, and as I said earlier, this is a time to be greedy. You'll find stocks at all kinds of valuations. They may appear cheap. You can still be greedy and then pick them up at a price that you want. And that's how investors should look at it.
Appreciate you taking the time out and speaking to us today. Thanks much.
Thank you, Neeraj. Thank you, Devina. Thanks for having me.
That's the Investec view on IT services. Not quite selling Wipro, but hey, let's wait and watch what the pre-open rates and then eventual rates throw up. So of IT is that one big talking point. The other two big talking points are banking and FMCG in particular. Mayuresh Joshi, head of Equity Research India at William O'Neill, joins us right now on the show. Mayuresh, good having you. Thanks so much for joining in. I'm really tempted to ask you about HUL and some of the other moves that we saw in trade yesterday. Now, Mayuresh, yesterday, because of that one-day buying due to the MSCI adjustment, we saw that big spike. The OI was up about 40-45%, probably because the futures were trading at a discount in the last half an hour. But do you think this rally is too much to digest? And should people who are sitting on these stocks take some money off the table?
Morning, Neeraj. So two aspects to the whole argument. The first aspect, obviously, is the tremendous pullback that we've seen from the lows for the indices itself. So I think the hope factor that is building up is that the curve probably might start flattening out. Some cases in Europe, for instance, Spain, Italy, have already exhibited that move. And a large element is that something that like this can be replicated. So that's one part of the entire argument. The second element, obviously, is the entire stimuli package that has gone through and the expectations that whatever economic fallout will take place, I think that will be taken care of. Now, in the context of defensives and consumption, specifically the FMCG stocks, to the likes of HUL, which have moved significantly higher, yes, I think it is relatively better placed from an earnings perspective. There will be degrowth because a lot of managements have put forth that they're not working at optimal capacity at this point of time. There are supply side constraints. There are constraints in terms of packaging, in terms of transportation as well, which probably still means that the earnings it will happen, but not as significant as a lot of the exposed sectors to the economy. So in that sense, again, I think the kind of consensus that is building up towards these stocks is somewhere where I think a lot of interest has come up. But valuations again have gone through the roof at this point of time. So really, I think at this point of time, if somebody is making reasonable amount of money, yes, I would suggest that partial money be taken off, wait out for earnings and wait out for the management committee going forward. Things will normalize. Things are normalizing. Industries have been asked to open up. So there is an element of hope that post Q2, I think these numbers will still keep on stabilizing compared to the others. But it's always making prudent sense that if you're making reasonable amount of money, I think at least booking some profits from these stocks is warranted in market rallies like this what we witnessed over the last couple of weeks.
Okay, interesting thoughts. Mayuresh, would love your thoughts on some of the key stocks and newsmakers as well today. So aside of IT, aside of FMCG, a bunch of stocks that you should focus on. Nikki Johnson with a quick list. Nikki, good morning.
Good morning, Neeraj. I'm going to start off with the downgrades first, where Tata Steel, Moody's has placed the corporate family rating of this particular counter for a review on downgrade. Similarly, it has gone ahead and downgraded Tata Steel UK corporate family rating. The outlooks have been revised to rating under review from stable that was seen earlier. A few days back, also Moody's had done the same thing to JSW Steel. Now it follows suit for Tata Steel as a whole, says that the whole environment is weak and the credit profiles of these companies essentially, make them more vulnerable to the kind of market sentiment right now, which is prevailing, in the widespread outbreak of COVID. Also, we're looking at India Cements. Now, CARE rating has gone ahead and downgraded long-term banking and NCD ratings of this company to CARE A negative from CARE A. Do remember that the Mani family is extremely interested in this counter, has picked up significant stake. And India Cements, as compared to most of its peers on YTD basis, also has done exceptionally well. So this downgrade is something that we need to keep an eye out on. We're also looking at Grassip con call. There were a few key takeaways from the con call which happened. The company has said that the strong cyclical headwinds across all the key businesses have put significant pressure on earnings. And the company, though, has strongly prioritized cash flows and capital conservation in the current environment. And they've also put on hold the capex plan that they were pursuing some time back. In two Baldes that we're talking about or we're looking at would be first IndianOpen Bank, where Goldman Sachs has gone ahead and acquired 0.65% stake in the counter, and also Metropolis Healthcare, where a small cap world fund has acquired nearly 2% stake in this counter.
All right, Nikki, thank you very much for that. So those are some things you need to keep out, on your radar this morning. The private sector bank, the other part, that's a significant selling that came about.
Devina, somehow I can't quite hear what you're trying to say. So let me try and take two or three of those questions to Mayuresh on those key stocks, and then we'll get in our chartists as well. Mayuresh, just one quick question. Again on Grasim, we know that companies are going to come out and give warnings. This seems to be a very severe stress warning given out by Grasim as well. Is that a stock that you would look at all? I mean, if you have it in your portfolio, would you recommend getting out of it?
No, so I think it's a wait and watch mode, and you're absolutely right, Neeraj. I think a lot of these companies within all these sectors that you spoke about, specifically Grasim, I think the kind of brunt that they'll probably face in terms of lockdowns, in terms of factories not operating at optimum capacity, and even if it starts, I think it's going to be a very gradual and a slow uptick in terms of facilities coming back on stream. The second element, obviously, is the disruptions, as I've said, for the industry as a whole. It's not just restricted to one. I think the supply side constraints are very, very evident as well. So I think Q1 earnings and the quantum of earnings hit is a large unknown at this point of time. What it really does is, I think it puts a lot of pressure in terms of how demand and how the demand curve will happen in the second half. So annualized earnings are expected to take a huge hit for most sectors, most companies within that. But which companies might survive and how the demand curve will pan out, specifically in the second half, because everything is going to bunch up in Q3, Q4. I think that is where I think the concerns lie. So I think I'll wait on the sidelines, Neeraj, for Grasim or stocks related to that sector.
But in your portfolio, you wouldn't get out of it.
I don't hold that, so.
Yeah, no, I was just wondering. Maybe, okay, Mayuresh, take that point. But, maybe we'll ask our technical experts what to do if you have it in your portfolio. But first, the larger question on the index. Mayuresh, stay on, so much more to talk about. The larger question on the index to Aditya Agarwal, Johnson right now. Aditya, always good having you. Thanks for taking the time out. How are you approaching trade today? We will start off lower. We ended about 1% lower yesterday. Banks even more so. Would you initiate a fresh trade at the opening prices?
Good morning, Neeraj. Always a pleasure to be on your show. Yes, below 88.75, my sense is markets will further weaken, and SGX is pointing towards an opening somewhere around 88.75 to below 88.75 on the index. And if they open anywhere below 88.75, my sense is that when it sustains below that for 10-15 minutes, my sense is markets will fall further and can slide to levels of 87.50 on the downside. So I'll initiate a short trade on Nifty below 88.75 for a target of 87.50 minimum. And if 87.50 is also broken, my sense is 8700 will also come through pretty quickly. You rightly mentioned banks are the ones which are actually dragging the markets lower, and banks have a lot of weightage on the Nifty as well. Really looking at the bank charts, it looks weak on multiple time frame charts, and 18,300 to about 18,250 is the immediate support on the downside. If that is breached, needed, my sense is that 1,000-point drop further on the bank Nifty and could be the one to lead the last leg of fall in the markets, which we believe is going to come through anytime soon.
Okay, that's a call coming in, probably looking at a further downside on the index. Samit Chauhan is also here with us. Samit, thanks very much for taking out the time this morning. We've seen a significant rally last week. Is this possibility of just that, profit taking off the table on the index, but does it question this move that has happened, or we're still in an okay zone as of now?
Yeah, morning, Devina. See, if we look at the larger picture, we are still not out of the woods. So the major direction is clearly on the downward direction, and recently we've seen a good recovery, nearly 20% recovery from lows of 7,500. So obviously, after seeing such a sharp rally in a span of a couple of weeks, some kind of profit taking was clearly on cards, and this is what we've been witnessing. And the kind of volatility that we have been witnessing in the market is at times it's quite intimidating. Yesterday we saw, in the first half, Nifty was convincingly above 9150, 9200 mark, and everyone was, saying that 9100, 9050 would act as a support now. But in the latter half, we saw, massive nosedive, and Nifty corrected back to 8900 kind of levels. And the way, the global cues are, shaping up, we believe that 8800 is a key level to watch out for. So if Nifty manages to hold this support level, then we might gyrate in a range of 8800 to 9000. So for the day, the range would be 9000 on the higher side and 8800 on the lower side. So any breakout in either direction will dictate the direction.
Okay, let's talk about individual stocks then. Samit, I'll stay with you. What are you recommending for morning trade?
See, we have a couple of trades. One of this, Motherson Sumi, which was clearly bucking the trend yesterday. We saw a good rally of nearly 10-12% yesterday, and the stock managed to surpass its recent hurdles with substantial volumes. So, in case of minor dip, it would make it a good risk-reward ratio. We would go long on Motherson Sumi, and we would expect this rally to extend. 79 is our near-term target, so it can be bought with a stop around 66.7. Another buy call would be on Tata Elxsi, which has been consolidating of late. And yesterday was the first day when the stock showed some kind of strength, managed to surpass its 20-day moving average on a closing basis. So we expect this relief rally to extend in case of Tata Elxsi. So it can be bought on any dip. Target would be around 784 and can keep a stop around 708.
Okay. Aditya, your stock ideas for the morning?
I want to buy in a sell, Devina. So Kotak Mahindra Bank is definitely looking weak. As I mentioned, banks are the ones which are dragging the markets lower. And Kotak Mahindra Bank is one of them which is definitely looking weak on charts. It's on the verge of a breakdown from a pennant pattern, from a small pennant pattern. So my sense is it will further slide lower to levels of 1050. One can initiate fresh shots on the future segment for a target of 1050, keeping a stop loss at 1235. The second stock is an interesting one. It's an HUL. Stock did witness a correction last week, and then from trade yesterday, it has bounced back, and there were good volumes in trade yesterday. My sense is the stock will continue its uptrend, which it has been showing, and when markets turn choppy or a little wobbly, FMCG stocks and IT stocks definitely tend to outperform, and it's looking attractive on the charts. My sense is it will test levels of 2630 on the upside. One can look to buy, keeping a stop loss at 2400 on the downside.
Those are some stock ideas for the morning. Talking about Kotak Mahindra Bank, yesterday saw a plunge in private sector banks post the Macquarie note, which slashed target prices by almost 45% across the board. Mayuresh, obviously one stock there, ICICI Bank, was maybe viewed in a slightly more favorable light. But what's your take on the path ahead for these private sector banks, and how much more pain is left for them to endure?
So I think, Devina, first of all, good morning. The valuations have definitely become far more attractive at this point of time. I think it's the only uncertainty related to the earnings aspect that these banks are taking a huge knock or a huge hit. It's an obvious expectation that with loan growth expected to slow down because of lockdowns, what happens in terms of the stability in asset quality numbers that they've been reporting over the past few quarters, the unsecured element of the book itself, whether it's MSMEs, whether it's credit cards, or even the housing part, where I think a lot of these loans have been meted out. I think what happens on those elements if this lockdown continues, and if there are further pressure points from an economic standpoint, I think that is what is creating a dual effect. The third element obviously is the expectations of how NIMs and spreads will hold up. And a large element is that with MCLR cuts happening, I think the deposit rates have also gone down. So I think with the readjustment happening in terms of both these variables, we're expected to see NIMs actually hold up for these banks, and return ratios actually come off because of the slowness in growth and expectations of provisioning increasing. So I think it's better off, as I've been time and again mentioning, I think wait out for numbers. I think there's no rush. I think you've seen with the US banks, they've actually started witnessing the pain. How they'll bounce back from the third quarter in those markets will be very, very interesting. So I think it's a prudent strategy to probably wait out for banking numbers, at least at this point of time.
Yeah, and we'll start seeing them trickling in too. So that's going to be an important watch. We're just a few minutes away from market pre-open. While Asia as a pocket is looking weak, so is SGX Nifty. I think just under 1% is where the SGX Nifty is currently trading at. After yesterday's sell-off in the market, once again, you're going to be starting off on a slightly weaker footing. U.S. equity futures as well are trading under by almost 1% for the Dow futures, as well as the S&P 500. The record low for the currency yesterday, 76.44. Wait to see what we do today's session on the back of also plunging crude oil prices. That's going to have its impact. It may be favorably for some paint companies, tire companies, everything that uses crude oil derivatives as raw materials. So that could be another aspect to look at. And then what happens to the likes of some of these upstream companies that this does not all go too well for them. ONGC, Oil India, and how they plan to how they align themselves with crude oil prices. The first ticks are up on your screen. So you've got Nifty 50, which is at about 8,900. That's moving down now, about 0.25% under. Sensex is down to 30,140. A few big movers in the session that we've got. One is Dr. Reddy's, which is showing you a 10% pop. HDFC Bank is at 893. And that's up marginally. UPL was the top performer in the index yesterday, was up 7.5%, and today is up about 4.5%. GAIL 0.5% higher, Bajaj Auto 2 marginally higher. But today is not a day, at least on the index, where you have more gainers than losers, more losers across the index. Wipro, the first reaction to the numbers, the pre-open tick is suggesting you a 10% cut. This probably something that was expected, looking at what the ADRs were also indicating. Titan is down about 4.5%. IndusInd Bank is showing you a 10% cut. Axis is down. Tata Steel, when the downgrade that has come in by Moody's, is down about 5%. ONGC 2.5% lower. Bharti Infratel, Bharti Airtel, all of these names looking weak. Britannia is also down. I just want to look at HUL and what that stock is doing. The big move that came in yesterday on the back of the MSCI rebalancing, that in today's session, I can't see HUL on my screen yet, but I don't think it's doing, it's down 5%. So the first tip for HUL also put yesterday's big move is down about 5.5%. Currency is not really, I can't see a change in the currency. It's still showing me 76.44. But Neeraj, what else have you got?
No, not too much. So we'll revisit these rates in a bit. Just that a couple of big movers of trade yesterday are cooling off. So Max Financial is down about 6.5. By the way, PVR is down 6.5 too after the gash yesterday. So that is now closing in on the 1,000 mark. So do watch out for those couple of names in trade. And something's happening with Parag Milk Foods. Now the stock has been on a roll after getting gashed down to 50.55. I think the stock in the last 1 month has gained 74%. The last 7 days, the stock is up 63%. But just be careful of such movers, really. You don't quite know what's happening behind the scenes. So just wait and watch. So let's revisit some of these rates once the rates settle down. But we'll take a call on Wipro and TCS both after the pre-open rates settle down with Samit Chavan. So you've got to keep that at the back of your mind. My question, though, from a tactical perspective, we've spoken about HUL both on the technicals and the fundamentals. Just that, keep in mind, HUL yesterday on the futures side saw a bit of buying in the last half an hour, massive OI addition, simply because futures are trading to a bit of a discount to spot over the last 30 or 45 minutes. The MSCI related buying is done today, viewers, and therefore keep in mind that the same kind of momentum that was witnessed in HUL yesterday may not necessarily get replicated. I know Aditya mentioned that he would probably be comfortable going long, but just keep this fundamental point at the back of your mind as well. However, Mayuresh, fundamentally, the ones which have lost out big time over the last few days are these multiplex stocks. PVR, I want to come to you on that one. We don't know when would aggregation as a policy become a norm again. Would you, if you have PVR or Inox in your portfolio, even if you don't have, think of somebody who has PVR or Inox in your portfolios, would you recommend getting out of those stocks?
So I think there are two aspects here again, Neeraj. Very frankly, I think, yes, it's a given that the earnings hit is going to be quite substantial. And managements have put forth on record there is no revenue coming through, obviously, because of none of the theaters and screens working at this point of time. And the costs actually start building up. So I think there is every plea that is being put through in terms of rental waivers and so on and so forth. There is a temporary reprieve because I think a lot of the contracting costs probably come off. But I think the majority of the billing and the gross margins that they derive, specifically from the food and beverages businesses, because of the shutdowns that we've seen. And you're absolutely right. I think even if this entire thing starts coming off over the next few weeks, I think people will remain extremely cautious. And again, I think the delay in terms of releases and so on and so forth, I think the earnings hit is a given. In this backdrop and context, I think if somebody is holding on, right, even till this point of time, I think the markets have to a large extent gestated the kind of hit that these movie exhibitors will probably display, both in Q4 numbers partially and Q1 numbers absolutely on a full and annualized basis as well. So with that respect, again, I think there might be some knee-jerk reaction that can still go through. But I think the bounce back will also be equally sharp and that is something to be observed as well. So I think anybody holding on, even till this point of time, I think don't lose hope. I think the earnings hit is a given for these stocks, but you can very well continue holding on to these stocks and not sell because I think the sell-off has been quite brutal. And you might be incurring a huge amount of portfolio loss holding on to these stocks. But I think you might very well hold on to these stocks over the next few months.
Okay. So do watch out for... it's watch out for these names. Let's wait and watch how they perform going ahead. By the way, a couple of interesting calls that have come in from brokerages, and those would be important. Samit Chavan, I want to come to you on the oil marketing companies. Yesterday, there was a tactical call from Morgan Stanley on HPCL. Bank of America Merrill Lynch has gone on an upgraded BPCL. Crude is lower too. That should act as a bit of a tailwind. Would you go long on BP or HP?
Yeah, they're not at current level. In fact, since last couple of weeks, within the oil marketing space, we've been quite bullish on HPCL from the levels of 180, and a couple of times in last couple of weeks, we have recommended this to our clients. It was a momentum trade, so we have booked out our profits after each 5 to 6% move after giving the call. And yesterday also we booked our call somewhere around 213. So now at current level, after seeing a good rally from the levels of 170, and the stock is now approaching its strong resistance zone, which is placed in the zone of 215 to 220. So at current juncture, risk to reward ratio will not be that favorable, and the stock is approaching its strong resistance as well. Yes, after surpassing 220, probably the stock would resume its high degree uptrend, but at current juncture, we would certainly avoid this counter.
Okay, I just want to focus on another stock, Bandhan Bank. Yesterday, we had some comments that came about from the MD and CEO, Mr. Ghosh, and he said that they don't apprehend any repayment issues owing to the nationwide lockdown to contain COVID-19, though at present, they have halted due to the curbs in terms of the overall repayments. But recovery of microloans have stopped. But also he said that interest will be recovered at the time of repayment, irrespective whether the customer has opted for the 3-month moratorium or not. But obviously, the key takeaway from that is that he's saying that they don't see any problem in loan repayment. I think the stock also recovered a bit, but the stock has been beaten down so badly, Mayuresh, that it would probably just be a factor of that bounce coming back in an oversold stock. What's your take on Bandhan Bank?
So I think they did manage to hold on in terms of how the performance has been. But a large element for the entire MFI universe is obviously going to be something that needs to be observed, because I think with lockdown pressures, with a lot of daily earners and daily wage earners probably not going to get a reasonable amount of revenue over the next few weeks, how the repayments will happen and how the collection efficiency will play out, whether it still holds on to that 97, 98, 98.5% is something to be seen. Also, the asset quality that is probably reported, the NPA is still below the 2% mark, net NPA is still below the 1% mark. Whether that still holds up is something to be seen and observed as well. The third element, obviously, is how they are expected to go through their entire disbursement cycle as well. So in terms of underwriting or credit dynamics, how are they going to disburse loans over the next few weeks, months, and quarters? I think that's going to be an interesting aspect in terms of how we are placed at this point of time. So I think I'll wait and watch, Devin. I think I'm not rushing into this. Again, as I said, I think the market is in a very, very fluid situation at this point of time. I think it's between that uncertain zone of what is to be done or not to be done. So I think it's better off laying out a lot more defensives or the defensive sectors at this point of time.
Yesterday's session saw some interest coming back into some of these specialty chemical names. UPL for one was up 7%, though Deepak Nitrite didn't do a whole lot much. But today, at least, and was the end of pre-open, Deepak Nitrite is suggesting that you could have a 5% top at open. Vinati Organics has been a very slow mover in this entire up move. Even when you're seeing days of a larger uptick for the rest of the market, Vinati seems to be a little bit of a laggard in that move. Samit Chauhan, are you tracking any of these specialty chemical names? And what do you make of UPL and the move that we saw yesterday and possibly today as well, and a Deepak Nitrite?
See, coincidentally, yesterday we had a buy call on UPL and it was clearly a momentum trade, some around 338. Stock was giving a decent breakout from its recent hurdles, and we booked out our profits as well. Stock has come off a bit from yesterday's high, but overall, if you see till the time it holds its previous resistance level, so 340, 338 would now act as a support. So till the time it holds this support level, the possibility of again this stock going back to 370, 375 cannot be ruled out. So within this space, UPL is the one stock that we have been closely tracking. So in case of a further dip, probably towards 350, 348 would make it a good risk reward ratio. So one can look to go long around those levels, keeping stop loss around 338, and again we would expect this stock heading towards 370 to 375.
All right, gentlemen, stay on with us. We're going to come back to you and talk about a whole host of other stocks and your recommendations this morning as well. But we're just minutes away from market opening, and we tell you all that you need to know to stay ahead in trade today. First up, Wipro reports a muted set of numbers for the fourth quarter. Operational margins contract sequentially, stop short of putting out quarterly guidance, citing virus outbreak. India's largest IT company, TCS, will report earnings today. Expect a muted quarter, with concerns around outlook largely to do with COVID-19. And BPCL seeks to cut Saudi Arabia oil imports by 50% in May as the tankers are full, reports Bloomberg News. Pratap Snacks says it's resumed operation at its plant in Uttarakhand, Maharashtra and Haryana. Endurance Tech's Italian arm has acquired 99% stake in Alda for 3.5 million euros. And lastly, Moody's downgrades Tata Steel's UK holding corporate family rating from B2 to B3. S&P also revises it lower to B+ from AA-. This is going to be an interesting one, taking a look at what some of these oil marketing companies are doing. And we've seen IOC do it, and now BPCL. I mean, they're not lifting supplies. They're not lifting crude now, because obviously tankers are running full. There is tremendous amount of supply where the demand is shrinking. And you've seen the IEA coming out and talking about US demand shrinking to a record. But Mayuresh, while they have been, the gas demand is increasing on one side. On the other hand, oil demand has been shrinking. So what lies ahead for some of these oil marketing companies, according to you?
So two aspects here, Devina. Clearly, I think with the shutdowns happening, with a lot of the petrol pumps not working at optimal capacities because of vehicles not flying on the road, there is obviously going to be a huge hit in terms of volumes. The second element obviously is how these cracks are playing out. If you're talking about the naphtha, the gasoline cracks and so on and so forth, the refining margins are expected to take a hit as well, which basically means that there will be reported advantageous inventory losses that these companies will report. To what extent and in what manner, and of course, is something to be seen. And the third element, obviously, is that even if valuations have become very, very attractive, I think this uncertainty related to both these factors, I think clearly plays out on earnings and subsequently in terms of cash flows, and therefore the entire question mark, even in terms of dividend payouts. So again, I think very, very watchful on this.
Mayuresh, we'll leave it at that. Thanks much for taking the time out and being with us today. Aditya Agarwala, can I ask you for a one quick 30-second view on Inox Leisure? Aditya, can you hear me?
I'll just get it. So there is weakness, Neeraj, in all these stocks, be it an Inox or a PVR. Looking at the trend of this stock, definitely there can be a short covering rally, probably a bounce back to levels of 260 to about 270 on the upside. But I'll not be too bullish out here. Probably from current levels, one can put a stop at 220 and look for a target of 260 maximum. After that, my sense is the stock will resume its downtrend. The stock is clearly in a strong downtrend and can test levels of 200 in some time.
Sure, Aditya. So quick, 10 seconds each. Your top call for the day today, Aditya.
It has to be a Kotak Mahindra Bank sell, Neeraj, for a target of 1,050, keeping a stop loss at 1235.
Samit Chavan, 10 seconds. Your top call for the day.
I'll go with Tata Elxsi for a target of 784, stop at 708.
Okay, gentlemen, just stay on. We'll take in quick opening thoughts from you. The markets are about to kickstart trade. We'll have a start in the red for sure, but the banks, from the way the pre-open session is looking like, may actually not do as badly as the large caps, as the Nifty and the Sensex, but at the time the open will tell us. We'll watch out for IT names for sure. Here's how the markets are indeed starting off. About 1% lower. Yes, about 1% lower. And surprise, surprise, it's not Wipro but Infosys which is starting off at the lowest point. Wipro is actually hardly lower, just about a couple of percentage points. But about 1% lower for the large caps. The Nifty Bank about 1.3%, so that corrects too. And let's take a look at what is lost and what's not. So Axis Bank 3%, Infosys about 3%, Kotak Bank about 2.5%, Titan, and now Wipro about 2.5%, about 6 or 7 rupees lower. Do watch out for TCS as well, though I don't quite see it in the list of the top losers. I must say TCS just about 1.5% lower in trade, so nothing too dramatic there. What about the winners? UPL, yesterday's big mover, though I must say it was up 16% and then ended only 8% higher, but it's up about 3.5% today. Reliance gains a little bit, about 1.5%. Britannia continues on its merry way, so that's not doing all that badly too. HDFC Bank is marginally in the green, and I can't not talk about HUL because I've been stuck on that stock today, and that stock starts off a couple of percentage points lower. That's the point that I was trying to make in the entire pre-open session too. It was a day's buying. It started off lower. Let's see if it corrects further or does it see a bit of a pullback, because this could well be routine profit booking as well in a stock that has done exceptionally well. Devina, what are you spotting?
Well, just a few names, and I would first like to talk about Motherson Sumi also. The breadth of the market is looking positive right now. You've got more advances and declines. And Motherson Sumi, I think, has just put out an exchange notification a few minutes ago talking about the board approving raising funds up to 500 crore rupees via NCDs. Remember Motherson Sumi and the big move that it saw yesterday? Good positive update, pledges getting repaid by the promoters. All of this, all of these pluses adding up, and today now you've got them saying that they want to raise more funds, about 500 odd crores by NCD. So, putting all that into perspective, from not too much in terms of gains right now, but let's see how the day shapes up. Aside from that, what else is doing well? JK Tyre is up about 8.5%. Remember, most of these tire companies and the paint companies will be in focus on the back of crude oil prices slipping the way they have. So even the CAT is up about 5.5%. Taking a look at a few of the movers, Vodafone Idea has moved up and it's up 50% in the last 7 days. Now at 4.6 odd rupees. First Solutions is up about 5.5%. Future Retail, Future Lifestyle, again upper circuit for both of these counters after seeing a barrage of selling. Viatech Vabag yesterday was up, today's up again. Sadbab Engineering is up. Watch out for Ashoka Buildcon, Dilip Buildcon. Now that you've got partial construction, which has been allowed to get restarted, 1/3 of the construction will start. These are the companies that will benefit from that, and therefore should keep them at the back of your mind. You've got the Intellect Design, which is up today in the session. Avanti Feeds is up 3.8% too. Navkar Corp, Rallis India. Then you've got Sobha. You've got the likes of Advent Irrigation, a very small name though, but it's up in the session. Divan Housing is up. Then you've got the likes of Jambal Fert, National Fert, Sudarshan Chemicals, Spark are up about 2.5%. Coming to the losers, then Marksans Pharma, some profit taking on the stock is down about 7%. Taracom is down 7%. Sri Lanka sugar stocks yesterday also were down. Today also Balram Puccini as well as Sri Lanka is down. Indian Hotels is down 4%. Jubilant Life is down 3.5%. Dish TV is down. Hexaware, Muthoot Finance 3% under. Tech Mahindra is also the other one that's looking weak. Petronet, LNG, TVS Motors, some of the other losers. But Brett has turned positive now. 641 stocks advancing, 554 stocks declining. And this has been the trend that we've been spotting for the last few days now, where the broader market wreck positive. Yesterday, you saw a clear outperformance within the mid-cap pocket was the large-cap index, where the mid-cap index was up 1% plus, as the benchmark index closed lower by 1%.
Okay, just before we get in, Saurabh Mukherjea, and he joins us right now. Just very quickly, Aditya Agarwala, on Tata Consultancy Services ahead of the numbers.
There is some weakness in the stock, without a doubt. Probably if it sustains below 1700 for quite some time, then my sense is it will slide further lower to levels of 1600. So you should clearly watch out for 1700. If it sustains below that, one can initiate fresh shots in TCS with a stop loss at 1750, keeping a target of 1600 on the downside. And
Samit Chavan, one last very quick thought on HDFC Bank, just a bit resilient today after the fall.
Yeah, the banking has been one of the weakest links of late, and HDFC Bank, which has been struggling around 930, 950. So that is the crucial resistance to watch out for. As of now, we expect this consolidation to happen, 850 on the low side and 950 on the high side.
Gentlemen, both of you, thank you so much for taking the time out and being with us today and giving us your thoughts. But on a day like this, and at a moment like this in the market, so important to get in. Saurabh Mukherjea joins us right now on the show. Saurabh, really good having you. More so today. Thanks so much for taking the time out. How are you looking at the current scenario, Saurabh? I know in the past you stated that it's virtually impossible for any of us to predict what the markets would do, and therefore you should only try and look at what your businesses or your stocks would do. But I'm just trying to get a sense from you. We've seen a state of fear, then a state of a pullback as well. Do you view this only as a pullback which will get sold into because the news flow around us is negative? Or is it difficult to analyze that also?
Good morning, and thanks for inviting me. At such a sort of interesting juncture for the markets. Look, leaving aside the human tragedy of what's transpired around the world over the last 90 days, from an investor's perspective, this is a mouth-wateringly interesting situation, right? Because you can see what's going to happen in the next 3, 6, 9 months. You can see that in sector after sector, the market leaders who have strong balance sheets, the ability to borrow cheap money on the back of RBI's TLTRO scheme, market leaders are going to go and consolidate their positions. And unfortunately, tragically perhaps, smaller companies, weaker companies are going to get crushed. So just like Demon, just like GST, COVID too will consolidate the hand of dominant franchises, and the theme that I've discussed on your shows over the last couple of years, which is in every sector, 1 or 2 players will end up garnering 80-90% market share. That theme will become even more entrenched. It's not pretty from an overall perspective, but making money in the stock market is a sort of Darwinian exercise. Every crisis strengthens the hand of strong, well-run, cash-generative franchises, and unfortunately, it weakens the lesser players. So it separates the women from the girls, so as to speak.
Saurabh, good morning. We've spoken about these consistent compounders every time we speak to you. Mm-hmm. In this period that we've seen this kind of whiplash for stocks across the board, yeah. How are these consistent compounders likely to probably cushion the blow for an investor? I mean, we've spoken innumerable times about the likes of HDFC, Bajaj Finance, and these kind of stocks. Sure. But these kind of stocks are the ones that have actually gone to cleaners in this.
Right. So if I look at our portfolio, right, if I look at the CCV portfolio, in the first quarter of this calendar year, Jan, Feb, March, we fell 12.5%, and the market fell, I think, around 30%, right? And then this month, like everybody else, we're up around 4%. So from 1st Jan to now, the CCP style of investing is barely down 7-8%. And interestingly, we have a small cap portfolio as well called Little Champs. That's also barely down 7-8% from 1st Jan to now. So that gives you a sense of what I've talked about for a long time, that if you invest in high quality compounders, in a crisis, you fall less than half of the market falls, right? And our reckoning is, as I just said, that companies like Asian Paints, companies like Relaxo, Dr. Lal Path Labs, all big holdings in our portfolio, will have a super time over the next 12, 18 months, right? But there's also another way to think about investing in the current context, right? So HDFC Bank, Bajaj Finance, to my mind, those are no-brainers. Just load up on those. We are loaded up heavily on those, and we don't have any doubt that we'll make buckets of money on both of these franchises. So that's the consistent compounder style of investing. But there's another way to think about making money in the current situation, which is think of stocks one notch lower who've also been beaten up badly, and where potentially the upside over a 2-year, 3-year period could be more. So, for example, in some of our portfolios, we have Axis Bank, right? So yes, HDFC Bank is down, but Axis is down even more. And if I look at, say, if I take the Lehman crisis as an illustration, HDFC Bank recovered very quickly from the Lehman crisis. I would say within 12 months. Less than 12 months. I think within 8 months, HDFC Bank made up the lost ground. But if you take a 3-year CAGR from the Lehman crisis, Axis gave better returns, right? So I think that sort of style of investing could also potentially work. That you take the frontline kings, the HDFC Bank, Bajaj Finance in the case of the NBFC sector, and I would add to that Kotak as a frontline king. These guys are, there are buckets of money on the back of the RBI's relief scheme, the rescue scheme. For them, lending and growing in this current environment will not be a problem. But Axis Bank also is flush with liquidity in the current environment. It has a strong CASA franchise. And so in some of our portfolios, we're also increasing our position size on something like Axis Bank. So incredibly interesting position to be in. If you have a portfolio replete with champion players, the frontline champions, the consistent compounders, I reckon, will continue gunning out good returns. The year ending March 2020, our portfolio delivered 10% up. So I'm looking forward to even making even more money in the year ending March 21. But what we're also considering is, should we increase our allocation to one rung below the frontline champions?
So what happens, so this downfall, exposed a lot of companies to selling who had a big export business or who had a lot of exposure to US markets, European markets, probably not so much so the domestic exposure. Do you feel then that, probably even in a portfolio when you are accumulating stocks, you should be mindful of business exposures and the external risk factor that you run?
I would put it the other way around, actually. So if you look at our country, barring IT services and auto to a lesser extent, we really don't have that much which is export-centric. So you have pharma as well. IT services, number 1, pharma 2, and auto 3. I think that's pretty much, 70-80% of our value-add exports. We do export, refined oil products and gems and jewelry, but I would count that as more like commodity-type exports, which will recover once the global supply chains are stitched together. So sort of value-add exports, IT services. Do we see a massive challenge in recovery? I don't think so. I think obviously the travel restrictions could have a bearing, but firms like TCS, I think you guys were discussing Infosys a few minutes ago, I think their business will come back. It's probably going to take 3-6 months for their business to come back, but as it is, I think revenues are not going to fall very sharply. There's no reason for in these sorts of annuity-style businesses for the revenues to fall sharply. New business growth could be stunted for a while, but I don't think it's a sort of structural issue. And if I look at the second sector, pharmaceuticals, where we have, say, something like Divi's Lab in our portfolio, I think it is almost a given that global big pharma will increase its procurement from India and seek to reduce dependence on China after everything, given everything that's fructified in the last 90 days or so. So if global big pharma increases its imports from India, whether it's APIs with Divi's Lab supplies or final formulations which other companies such as Sun Pharma, etc. supply, I'm not so sure why the pharma sector is going to be in a bad place, right? And if you then go to the next layer, auto and auto ancillaries, there you could argue there is a challenge, but I think that's a challenge because across the world and potentially in India as well, auto demand could get postponed by 6-12 months. But it's not clear to me that there's a enormous challenge for the export-oriented sectors. Notably, IT, pharma, and auto have strong balance sheets. And whichever of these companies want to raise money, I think we'll probably get some of the cheapest bond market financing in India ever in the next 6 months, right? So these three sectors, I don't think there's a massive challenge. Obviously, there's going to be a revenue growth will stagnate for 6 months, perhaps even 12 months. But I don't think there's an existential issue. Where you'll have challenges is, say, sectors like real estate, telecom, power infrastructure, where balance sheets as it is were stretched pre-COVID. And post-COVID, the financial situation could get a little tougher. So airlines, leisure, hospitality, hotels, right? Heavy balance sheet, capital-intensive sectors with stretched balance sheets pre-COVID, and as they have a tough year from a revenue perspective, they could be in a little bit of trouble. But P&L oriented sectors with cash, balance sheets groaning with cash, sectors like IT, pharma, and auto, I'm not so sure it's that big a challenge for them. Provided the global economy settles down over a 3-6 month period.
Saurabh, just one final question on this interaction, and that is, if you foresee any business models that would be changed forever and for the worse off once this settles.
I think why don't I sort of take both sides of it, the better off and the worse off. I think what the last 60 days has taught lots of us is you can actually do lots of work very productively sitting at home, right? And the use of collaboration software, things like Microsoft Teams, and for those of you out there who might be using other types of software, it's clear that we can get a lot done from home. And whilst there's a lot to be said for meeting people face to face, I think non-essential travel, whether it's within a city or across cities or across countries, I think non-essential travel will get pulled back for some time to come. Not just because of the cost considerations, not just because of the amount of time it takes up to wake up in the morning, take a flight to another city, but also because of the attendant health risks that it poses, at least for now, right? So therefore, I think that the travel and transport sector, in the broadest sense of the word, I think we'll have to rethink how it goes about configuring its business model. I think that's the sort of the difficult the sector where I think there will be business model issues. But on the positive side, the whole aspect of services businesses, including our IT services industry, including our KPO industry, which does so much business with the rest of the world, I reckon the COVID crisis will be an enormous fillip for them, because it would have illustrated to Western companies how much more work they can actually send to India, or indeed to other lower cost destinations. So I would come out of this crisis looking at the situation quite positively for a country like ours, whose main competitive advantage is knowledge and human capital, whether it's via the pharma sector, whether it's via the IT services sector, or indeed for the country as a whole. This is a once-in-a-generation reset, which I think will set the trigger for India's fifth economic boom in 40 years. We've only had 4 booms in 40 years. We badly need the 5th one. And interestingly, before every single economic boom in India comes a US recession. We have never had a boom in India without a US recession. A US recession is a necessary and a sufficient condition for the Indian economy to boom. I reckon the chances are very high that over the next 2-3 years, we'll see an economic boom in India.
Yep, in adversity, we see some opportunity. Thanks, Saurabh, for joining in. Really appreciate you taking out the time.
My pleasure. Thank you. Thanks for inviting me.
Bye. Saurabh Mukherjea there of Marcellus Investment, talking about coming out of this with significant opportunity. Just a quick update now before we start wrapping up the show on the latest details on the coronavirus contagion here in India. The latest numbers as of 8 a.m. this morning suggest that the total confirmed cases have risen to 12,380 cases, with the number of active cases 10,477. The cured, discharged, migrated number has increased, so that's the silver lining, 1,489. But the deaths have also gone up, so 414 deaths in the last update that we've got. So last 24 hours, 37 deaths. We've seen recoveries, 183 recoveries, fresh cases of 941. There's actually a dip from the last 2 days where you've seen over 1,000 cases getting reported, fresh cases rather, getting reported here in India. But, We were talking about it in the morning, and comments that were coming about from Ray Dalio. So he sees no reason why investors should hold bonds. The founder of Bridgewater Associates says that one should stick to firms with strong balance sheets. Speaking to Bloomberg, he says the world will not be same anymore. Listen in. Thanks a lot for watching.
I believe that as we distinguish, we can do that by countries and parts of the world, and we could do that by asset types and so on. I believe that when you look at bonds and debt, a bond is a promise to receive currency. So you have, when you're holding a bond, that gives you no interest rate or a negative interest rate, and they're producing a lot of currency, and you're going to receive that. Why would you hold that bond? Okay, and where is that bond, and who owns that bond? Okay, so this period, like the 1930 to 45 period, is a period in which I think you'd be pretty crazy to own bonds. Okay, because what is a debt? A debt in a fiat currency is a promise to receive currency, and isn't it pretty clear they're going to make a lot of currency? So I think that changes the appeal of bonds. Why in the world would you hold the bonds? And that has a big effect. So when you start to think about how much wealth is in bonds, and where is that wealth going to go, and how's that going to work, and how are they going to control it? You know, I have real thoughts about that. So what is a good storehold of wealth when we're all holding all of these debt assets, and how will that play out? That'll be an important consideration. Another, and that has to do with storehold of wealth. And so when I think of storehold of wealth, I think, what are the stable storehold of wealth in the form of stocks and other kinds of debt? I want those that have strong balance sheets, stable incomes, and so on, so that you're basically having those assets that will perform well in any kind of an environment. And I'll look at them based on how cheap or expensive they are. And when I think of the world, I divide the world into different locations. As I say, I think that this picture is very much like the 1980 to 90 period, when we're flooding it with financial assets, with money and credit, but they're not getting to a number of emerging countries. So when I look at the distribution of wealth in terms of their balance sheets, like every individual, I look at what is their income, what is their expenses, and what is their savings. And when we go through that exercise, then it changes. I don't want to be in places that don't have good ones. And then I look at civil behavior. How are people with each other? Is there going to be a fight? And will that fight, will people be orderly? Will we work it out? And then what will be the changes in tax rules? Taxation. Will corporate taxes come back in certain ways? What will the changes? Because we're not going to deal with that equally. So I'm looking at all of that to create a picture of differentiation. I see a very differentiated world. And when we talk about the economy coming back, I think you have to realize what big changes are that are behind that can't be changed. Let's say, for example, self-sufficiency. I think we're going to produce different things and we'll be self-sufficient. We operated in a world where we were globally connected, and whoever was most efficient would get it, and we would just go get it wherever it was most efficiently produced. That world won't happen again. So you're going to come to a world where you'll originate it, produce it at home, and that you'll start to think about what do you need. And I imagine that we're going to be rebuilding our basics, healthcare systems. How much savings are we going to put into rebuilding some of those basics, like basics of hospital? What's our storage for the next time we have the next epidemic? And then there'll be other things, climate change. This is the act of nature that hit us over the head, the virus. but there's other evolutionary costs that are going to come in the form of climate change and those types of things. All of those things are important to imagine in imagining the new world order, I think.
According to a recent report, women today contribute nearly 74%